Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Central banks' policy tightening, FX market interventions, rising geopolitical tensions, and concerns of a global recession have all caused elevated levels of cross-asset volatility during July to September quarter this year. Also, uncertainty around macro outcomes have fed into concerns of systemic risks, which in turn increased cross-asset correlations. Indeed, the third calendar quarter this year should get a special mention in the books of financial market history. Central banks are tightening their policies, both conventional and unconventional, at a record pace to fight inflation. Close to 300 rate hikes from the central banks over the past year and more than $3 trillion in quantitative tightening have started to feed through into the global economy. These days, for every central bank that is cutting rates, there are 25 central banks raising rates. The month of September also saw some central banks, including the Bank of Japan and Reserve Bank of India, even intervening in the FX market to bring stability to their domestic currencies against the US dollar. Japan spent $20 billion in just the last week of September to defend the tumbling yen. Also, Reuters reported on September 29th that China's central bank has asked major state-owned banks to be prepared to sell dollars for local unit in offshore markets as it steps up efforts to stem the yuan's descent. Month of September also saw fiscal policy actions in Europe. UK's new Chancellor announced debt-financed tax-cutting package worth 45 billion British pounds sterling, which sparked a sharp rise in borrowing rates and acute volatility in UK's currency. Geopolitical risks rose sharply on escalation in US, China, Taiwan, and Russia, Ukraine situations. Italian elections increased the political concerns in Europe. On the data front, Global Economic Surprise Index, which measures the extent to which reported data surprises or disappoints in relation to the consensus expectations, was positive for the first time since May 2022. Inflation Surprise Index has continued to moderate further from its peak of April 2022 but remained elevated. However, the concern that inflation has not fallen enough caused markets and policymakers to contemplate about the future of monetary policy. It's well known that financial markets turn volatile when faced with more than one risk, and especially when there is uncertainty around macro outcomes. So far this year, increased volatility across bonds and currencies has fed into risk assets like equities and commodities. Implied volatility in bonds is elevated and is now close to its 2020 pandemic peak. As a result of the volatility, global stock and bond markets together have lost a record $36 trillion in value in the first 9 months of this year. For the context, during global financial crisis of 2008-2009 and in the COVID-19 pandemic-induced sell-off 2020, the losses were just under $25 trillion. Also, the pace of this erosion in market capitalization was alarming. It took about 18 months between mid-2020 and late 2021 to create $36 trillion, while it was lost in a matter of just 9 months. In the US, 10-year Treasury yield is on track for a record rise in 2022. Hawkish Fed pushed the yields on 2-year US Treasuries to the highest level since October 2007 and the yields on 10-year US Treasuries to the highest level since November 2008. US stocks have notched their longest streak of quarterly losses since the market collapse of 2008. S&P 500 index ended Q3 at the lowest level since November 2020. In real, that is CPI adjusted terms, the index is back below the pre-pandemic highs. Turning to currencies, increasing uncertainty around global economic growth and Fed's hawkish policy have helped enhance the famous dollar smile. As such, the broad US dollar rose to a 20-year high during September. Stronger US dollar and weakening global growth prospects have also caused the commodity prices to correct sharply over the recent months. Between June and September, commodity prices in aggregate have fallen by 20%. Looking ahead, as we've been arguing, it's the market's assessment of the appropriateness of the monetary policy for the level of growth-inflation mix that matters for financial markets. In that context, the clear risk here is that the central banks go too far, too fast with tightening and eventually commit a policy error. Until there is a confirmation that the policy error can be avoided, financial markets are likely to remain volatile. However, in our view, the worst of the financial market performance might be largely behind us. Should the policy error be avoided, markets are likely to recover strongly over the next 12 months. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. You are listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.